In 1989, Japan's imperial palace land was valued higher than all the real estate in California. By 2014, China had built entire empty cities, and 70% of household wealth was tied to property. Yet both nations believed collapse was unthinkable until it struck. Now, the same seven-stage pattern is unfolding in the world's largest economy. If this cycle never spares superpowers, how close is the US to its point of no return? In the late 1980s, Japan's economy seemed unstoppable. Tokyo's skyline filled with cranes and neon, as real estate prices soared to levels the world had never seen. Land in central Tokyo tripled in value within just a few years. At the frenzied peak, stories spread that the grounds of the Imperial Palace, barely over 1 square kilometer, could be worth more than all the real estate in California based on prices in the neighboring Marunouchi business district. While this comparison relied on wild assumptions, it captured the mood. A nation convinced that prosperity had no ceiling. The Nikkei 225 stock index reflected this euphoria, climbing relentlessly to an all-time high of 38,915 on December 29, 1989. Companies borrowed freely, banks handed out loans with little hesitation, and families poured their savings into property and stocks. Newspapers and television hosts repeated a single refrain: Japan will overtake the United States. Economists, traders, and everyday citizens alike believed that old rules no longer applied. The country's total land value reached as much as $24 trillion, nearly 4 times the value of all United States land at the time. In offices and trading floors, the mood was one of a measured awe, mixed with a sense that the good times would last forever. But beneath the surface, the seeds of a painful correction were already taking root. The first stage of the collapse pattern had arrived, marked by unchecked optimism and asset prices divorced from reality. Skyscrapers rose across China at a pace the world had never seen. Between 2000 and 2014, more than 400 million people left rural villages for cities, an urban migration larger than the entire population of the United States. Concrete, steel, and glass transformed the landscape as planners and state banks fueled a construction boom with almost no precedent. New highways, high-speed rail, and entire city districts appeared in years, not decades. But beneath the surface, the story was not just about growth. It was about where the money went. Property became the anchor of household wealth. By the middle of the 2010s, nearly 70% of Chinese household wealth was tied to property. Families saved for years to buy apartments, often before a single brick was laid. Developers, flush with easy credit, raced to build ever more ambitious projects. Some cities remained half-empty, their towers lit only by a handful of residents. Still, the push continued, driven by the belief that real estate could only rise. China's ambition stretched far beyond its borders. Through the Belt and Road Initiative, Beijing extended loans to more than 150 countries, funding ports, highways, and railways from Africa to Eastern Europe. These projects promised influence and new markets, but also tied China's fortunes to the ability of foreign borrowers to pay. The vast sums lent abroad mirrored the excess at home, credit chasing opportunity, with risk accumulating just out of sight. The scale of this era was staggering, but so was the concentration of wealth and risk. As more money poured into property and infrastructure, the foundation of China's prosperity grew ever more dependent on asset values and continued expansion. The golden age, for all its achievements, carried within it the seeds of future strain. Soviet leaders in the 1970s faced a stark calculation. Matching the US and global influence demanded an enormous military machine. Defense spending consumed as much as a quarter of the Soviet Union's entire economic output, a figure that dwarfed the burden faced by any Western rival. Secret memos from the finance ministry warned the Politburo that this level of commitment was unsustainable. In 1982, Minister Vasily Garbuzov wrote bluntly, "Matching the US will bankrupt the Soviet system within years." The invasion of Afghanistan in 1979 deepened the strain. Soviet troops poured into Central Asia, and the costs mounted with every passing month. The war, intended to secure a friendly government, turned into a decade-long quagmire. Billions of rubles flowed out of Moscow, funding military operations, supplies, and propping up an unpopular regime. The financial drain rippled through the Soviet economy, compounding the effects of an already rigid system. At home, the consequences became impossible to ignore. Central planners focused on weapons and heavy industry left supermarket shelves bare. Across Moscow, Leningrad, and Kiev, citizens queued for hours in the hope of buying bread or sausage. Ration books became a daily reality. Diaries from the era, like that of Moscow schoolteacher Elena V., tell of rumors swirling through the lines, whispers that the system itself was on the verge of collapse. She wrote in 1985, "Bread but no butter, sausage but only for the party." Shortages and black market trading eroded faith in the state's promises. By the mid-1980s, the Soviet Union's vast resources were bleeding away, not only on distant battlefields but in the daily lives of its own people. The pattern was clear: external overreach, fiscal exhaustion, and growing public discontent. Cheap money can buy time, but it can't erase risk. In the late 1980s, Japan's central bankers faced a dilemma: international pressure to strengthen the yen and domestic pressure to keep growth alive. The Bank of Japan responded by slashing its official discount rate from 5% to 2.5% between 1986 and 1987, flooding the system with easy credit. Bank lending soared, fueling the asset bubble that would later haunt the country for decades. Board minutes from 1986 show officials acknowledging the risks but pushing ahead, citing global commitments and the need to keep the economy humming. Asset prices detached from reality. The warning signs were buried beneath a tide of cheap loans. China's policymakers watched and learned. After the 2008 financial crisis, Beijing unleashed a wave of credit, but much of it flowed through hidden channels. Shadow banking expanded rapidly. Trust loans, wealth management products, and off-balance sheet local government vehicles exploded from under 10% of GDP to nearly 90% by 2017. By then, shadow assets topped $10 trillion, rivaling the size of the formal banking system. These funds propped up developers and local governments, masking rising defaults and keeping official loan books clean. Even as property markets faltered, new credit kept flowing, often beyond the reach of regulators and public scrutiny. Meanwhile, official data painted a calm picture. Inflation, as reported by China's National Bureau of Statistics, rarely strayed above target. Yet independent studies and IMF research point to persistent understatement by as much as 1 to 3 percentage points each year. Quality adjustments, selective price tracking, and opaque methods made rising costs look smaller than they were. Together, hidden credit and data smoothing delayed the reckoning. The pattern was the same. Monetary tools, wielded by central bankers, bought time and obscured risk, but could not prevent the eventual fallout. Stage 4 is defined by this masking, when the numbers say stability, but the underlying system is quietly unraveling. America's debt now stands at over $34 trillion, a figure that grows by the second on the Treasury's own digital clock. Interest payments alone have climbed past $1 trillion a year, now outpacing even the annual defense budget. Behind closed doors, Federal Reserve officials debate how much longer the system can absorb this pressure. Internal emails from the Federal Reserve Trading Desk in March 2023 describe a market where bonds simply will not clear unless the central bank steps in to buy. The Fed's balance sheet has ballooned by trillions of dollars, plugging gaps as borrowing outpaces tax revenue. This is not abstract theory. It is borrowing to pay interest, a textbook sign of a debt spiral. Each round of new spending is funded not by surplus, but by creating more money or rolling over old obligations. The numbers point to a cycle that is mathematically unsustainable. The top 1% of Americans now control over 30% of the nation's wealth. For most families, wages have lagged behind prices for decades. Surveys show only 17% of Americans trust the federal government to do what is right. Discontent has spilled into protests, strikes, and bitter political divides. Meanwhile, central banks from China to Brazil are buying record amounts of gold and settling more trade outside the dollar. Finance ministers from the BRICS nations openly discuss alternatives to U.S. reserve dominance. At the same time, the IMF and Bank for International Settlements are piloting digital currency baskets, with working groups drafting contingency plans for a future where the dollar is no longer the world's anchor. History shows reserve currencies rotate every 80 to 100 years. The signs point to a system under stress, with the possibility of a global reset moving from theory to active debate. Today, the United States pays more in interest than it pays on its military, a signal no superpower has ever ignored for long. As debt compounds and trust fractures, the next chapter is not written by economists. It is written by those who recognize the pattern before it completes. The clock is running,